The Relative Vigor Index indicator, also known as the RV indicator, is a technical indicator which anticipates changes in market trends. In this video, we will reveal the most powerful strategies used with the Relative Vigor Index. This will hopefully help you a lot in your own trading, and you will be able to anticipate market trends and directions with this knowledge. If you want to show your support, hit the like button and feel free to subscribe and turn on the bell to stay notified when we upload new videos. The Relative Vigor Index is an oscillator based on the likelihood of price closing higher than the opening price in an uptrend, and similarly, closing lower than the opening price in a downtrend. Basically, it is an oscillator that is in phase with the cycle of the underlying price. The RVI tries to measure whether a market is bullish or bearish. It does this by measuring the strength of a trend and comparing the closing price to its trading range while smoothing the results by adding a simple moving average. This can help inform our opinion of how we expect the market price to move going forward. It's because of this the RV indicator is labeled as a leading indicator. The Relative Vigor Index is very similar to the stochastic oscillator, the Relative Strength Index, and MACD, which are very popular indicators used by many traders. We will make videos about the stochastic oscillator, RSI, and MACD, and many others in the upcoming weeks, so be sure to subscribe to our channel so that you don't miss it. Which settings to use and how to read the Relative Vigor Index indicator. RV indicator has two lines, a green line that is a standard moving average. The value of this green line is 10 periods, but you can change it to fit your needs. Some other common settings are the 7, 14, and 21 periods. The higher number of RVI periods you use will decrease the number of trade signals. This is positive because there's less chance of a false trade signal. The downside to higher RVI periods is that you can get late signals. Similarly, the lower RVI periods you use will increase the number of trade signals, and you will get fewer late signals. The red line is a 4-period volume weighted moving average. It's the trigger line because it provides trade signals when the green line crosses the red line. This indicator was originally devised, like so many other popular trading indicators, to be used in conjunction with end-of-day price data. But there is no reason that the indicator cannot be used for other time frames also, like day trading and scalping. Don't worry if you are concerned that the calculations seem a little too involved. It's useful to understand the basic principles behind how the indicator works. The actual work is taken care of by the indicator itself, so let's take a look at different powerful strategies used with this indicator. There are various types of trading strategies that can be used with the Relative Vigor Index. In this video you will learn 3 powerful strategies. RVI Divergence strategy uses the divergence between the RV indicator and price. This suggests a possible change in the trend direction. RVI Crossover strategy is used to provide possible entry signals. A crossover of the signal line suggests a possible trend change. And RVI crossovers as a trend-following strategy gives us a bullish or bearish crossover signal in an already established trend. These are the 3 most popular trading strategies to use with the Relative Vigor Index. And first out, RVI Crossover. RVI Crossover strategy is used to provide possible entry signals. A crossover of the signal line suggests a possible trend change. When the green line crosses the red signal line from above, it signals a possible sell opportunity. And when the green line crosses the signal line from below, it signals a possible buy opportunity. You can see in this example the green line crosses the red line from below, then the price is going up. And in this example, you can see the green line crosses the red line from above, then the price is going down. As the indicator naturally moves in a wave pattern, we can attempt to add a rule to restrict trades to more favorable conditions to limit false signals. this would mean only acting on a crossover signal to buy if the RVI is below 0. Similarly, we would only act on a crossover signal to sell when the RVI is above 0. You can see in this example the RVI is below 0, and the green line crosses the red line from below, then the price is going up. And in this example the RVI is above 0, you can see the green line crosses the red line from above, then the price is going down. In addition to this, we can use the RVI crossover to ride an existing trend with the trend following strategy that we will show you now. Price normally moves in wave formations like water waves. When the price is trending bullish or bearish, we can take advantage of this by using RVI crossover in these situations. In a trending market, both bullish or bearish trend, we aim to get a crossover signal in this wave's pullback in price. In this bullish trend, we can see price moves upwards in a wave formation, and we will get a possible buy signal when the green line crosses the red line from below like this. In this bearish trend, we can see price moves down in a wave formation, and we will get a possible sell signal when the green line crosses the red line from above like this. Important RVI limitations, and what to look for. The RVI tends to work better in markets that are trending as it can generate false signals and data when applied to range-bound markets. Many traders use RVI as oversold and overbought signals. Traders would say that when the RVI value is low, the price is considered oversold, and a high RVI value means that the price is overbought. This can be dangerous, because RVI doesn't show oversold or overbought conditions. Rather, it shows momentum and measures the strength of a trend. Traders should keep in mind that during periods of very strong trends, the price may continue to rise for a long time after an oscillator such as the RVI signals overbought. The same applies to extended downtrend price movement that may occur well after an RVI indication being oversold. This chart shows how the RVI behaves in a long uptrend and in a long downtrend. In both scenarios the indicator come to the overbought and oversold areas and stayed there for a long time, while price keep moving up with the trend. One way we can aim to improve the RVI signals is to set long-term look-back periods. This will reduce the impact that short-term counter trends have on the overall data, and take out short-term changes from data readings, and you get more clean results. The last strategy is the powerful RVI divergence. RVI divergence can signal early changes in the direction of the trend. Divergence is when the price of an asset is moving in the opposite direction of a technical indicator, such as an oscillator, or is moving opposite to other data. Divergence warns that the current price trend may be weakening, and in some cases may lead to the price changing direction. If the price is rising and the RVI indicator is falling, it predicts that the price can reverse in the near future. To get a change in trend, for a bullish signal, the price has to make lower lows, and the RVI makes higher lows. Similarly, to get a bearish signal, the price has to make higher highs, and the RVI makes lower lows. In this bullish example, we can see the price making lower lows and the RVI making higher lows, indicating a change in trend. Then the price moves to the upside as anticipated. In this bearish example, we can see the price making higher highs and the RVI making lower lows, indicating a change in trend. Then the price perfectly moves to the downside as anticipated. Finally, to sum up the RVI, the Relative Vigor Index is an indicator built on an assumption that the closing price of a period, let's say the end of the day, is a key characteristic tied to the force behind a market move. When the momentum of a market is bullish, we tend to observe higher closes. In a bearish market, we tend to see lower closing prices. Using this simple principle, the RVI indicator provides clear signals of when to trade. We hope that you find this video about the RV indicator to be useful in your trading and for a better understanding of changes in the market. If you watched this video and find it valuable, make sure you share it with a friend who might also be interested in this topic. As always, give us a like if you learned something new and want to see more videos like this. Subscribe to your channel and hit the bell to stay notified when we upload new videos.